Is the U.S. housing market crashing? Investors are canceling contracts and slashing prices to clear inventory, which begs the questions. Why are investors leaving the housing market? Is it time to panic, or is it time to act? Don't make a move until you watch this video and learn the truth about what's really happening. To understand what is going on with the U.S. housing market today, let's take a detour to the big crash in 2008. In 2008, the investor contributed to less than 10% of the real estate market. But slowly, over a decade, investors became a more significant part of the industry. And by 2020, a record high of well over 20% of all homes sold in the US were bought by investors. The reason for the 2020 massive increment of investors in the industry is that real estate has slowly transformed into a tradable commodity rather than a shelter. Investors have entirely reshaped the market, adding leverage and liquidity. But this essentially means that it pushes prices up. But these exact mechanisms that push prices up now work in the opposite direction as recession risk mounts. Join us as we explore the reasons behind the accelerated real estate market slowdown in the US and what to expect in the near future. Why are investors leaving the real estate market in the US? Several investors are leaving the US real estate market today, causing a severe decline in the market value. In the third quarter of 2022, investors' home purchases fell by 30% year over year in the US, which is the most significant decline since the Great Recession. Aside from the second quarter of 2020, investors' activities plummeted in the second quarter of 2020 due to the onset of the pandemic. Metro areas like Phoenix, Arizona, Portland, Oregon, and Las Vegas, Nevada have it worst as investors' purchases year over year dropped by 49.4%, 44.4%, and 44.8% respectively in the third quarter of 2022. There are several reasons investors are pulling out of the real estate market in the US, and below we'll be elaborating on some of the reasons. Higher borrowing cost. One concern synonymous with investors in the real estate industry is that the cost of borrowing is becoming increasingly high. After years of cheap money, it is much more expensive to borrow today. Also, the inflation rate in the US, up by 7.7%, is not making things any easier for investors. The increased borrowing cost is due to the Federal Reserve's plans to raise its federal funds rate. Since March, the US Federal Reserve has raised its short-term benchmark rates by 3%. Better Treasury Bonds rates. Another reason many investors are pulling out of the real estate industry is that the US Treasury Bonds rate looks more alluring. Considering the risks involved with real estate, no rational investor would want to deal with that when they can get similar returns buying Treasury bonds. Right now, the US 5-year Treasury bond deal is at 3.78%. Generally, the more this bond deal rises, the less appealing the real estate industry will appear to investors. Slower sales. Investors' withdrawal from the US real estate market is more apparent as the housing market is slowing down. The rise in mortgage rates and affordability issues are critical factors behind the home sales slowdown. After nearly doubling mortgage rates since the end of 2021, investors must navigate a dynamic where home values and borrowing costs are relatively high. Investors are pulling back to help prices settle at more affordable levels to prevent a total loss. Drop in buyers' demand. The drop in buyers' demand for homes, which results in slower sales, has a lot to do with the prices of homes today. For example, in areas like Phoenix, the median home value was around $275,000 in January 2020. But earlier in 2022, the price jumped by over 70% to $475,000 in less than 24 months. This high rate of homes was primarily due to the greed of investors, inflation, and so on, thus leading to less demand. And when investors cannot make sales faster, they are less profitable. Lower capitalization rate. The US real estate capitalization rate condition is another reason investors are pulling out. Investors use the cap rate to determine how much they could make yearly, given their investment. Since the cap rate is the return on an asset, higher risk-free rates mean investors will have to increase cash flow or reduce their price expectations. Since real estate is not a risk-free investment, the increase in interest rate puts a lot of pressure on the cap rate. As such, in the first quarter of 2022, the cap rate of the real estate market declined to 4.3%, which is approximately 1% lower than the national cap rate of 5.3%. What does the future hold for the real estate market in the US? With how real estate is performing today, history is about to repeat itself. While things are not looking so promising for the industry right now, almost like last time, the housing market rarely falls off a cliff. Considering the issues the real estate market faced about 14 years ago with bad loans, today the issue is somewhat different as the industry faces a bad economy, institution withdrawal, folding demands, and so on. If we consider a boomtown like Phoenix, the last time there was a crash, home values peaked in the fourth quarter of 2006. But when the downfall started, they fell for almost 4.5 years and bottomed down in the summer of 2021. Imagine if investors who bought homes in the winter of 2006 wouldn't have seen their equity recovery until the summer of 2019, which is about 13 years of waiting. This example shows that the real estate industry always recovers, but it does so very slowly. So although things may not be looking favorable now, experts predict that in the nearest future, the market will peak again. In conclusion, the real estate industry's decline can be likened to what it faced during the pandemic or the crash in 2008. While it takes considerably longer to recover your equity considering the industry is down, it is almost certain that history will repeat itself and the market will soar again.